the invisible highway of India's digital economy. Imagine waking up tomorrow morning and unlocking your phone. Within minutes, your bank sends an OTP. Your food delivery app confirms breakfast. Your office sends a login code. A payment app alerts you that money has been credited. Later in the day, your airline reminds you about your flight, your hospital confirms an appointment, and your insurance company sends a policy update. By the time you go to bed, dozens of digital messages have quietly reached your phone. Now here's a question that most people have never asked themselves. Who actually carries all those messages? We know the bank. We know the delivery app. We know the telecom company. But between the business sending the message and your mobile phone, receiving it lies an invisible layer of technology. A digital highway that most people never see, yet billions of transactions depend on every single day. If that highway stops functioning for even a few minutes, banks can't authenticate customers. UPI transactions become difficult. E-commerce deliveries slow down. Airlines can't notify passengers. Hospitals struggle to communicate with patients. Even government services begin to experience delays. This isn't just messaging. It has quietly become part of India's digital infrastructure. And hidden behind a significant part of this infrastructure is a company that most retail investors ignored for years: Tanla platforms. But to understand why Tanla matters, we first need to understand something much bigger than the company itself. Over the last decade, India hasn't merely become a nation of smartphone users. It has transformed into one of the world's largest digital economies. Government initiatives such as Digital India accelerated the digitization of public services. UPI changed how money moves. Aadhaar enabled digital identity at scale. Businesses shifted from physical customer interactions to app-based experiences. Consumers began expecting instant confirmations, real-time alerts, and secure authentication for almost every digital activity. As this digital transformation gathered pace, something interesting happened. Every new digital service, whether it was a bank, an e-commerce platform, a healthcare provider, or a government portal, needed one common capability: reliable communication with millions of users. Not marketing messages. Not advertisements. Mission-critical communication. The one-time passwords that allow you to log in. Transaction confirmations. Fraud alerts. Payment acknowledgements. Delivery updates. Appointment reminders. Messages that consumers don't merely read, they depend upon. Think of it like India's road network. When you order something online, you see the brand that sold it and the courier that delivers it. But behind that visible experience lies an enormous network of highways, warehouse, traffic systems, and logistics planning that most people never notice. Digital communication works the same way. Customers see the app. Businesses see the customer. But connecting both ends is an invisible infrastructure layer. That is where companies like Tanla operate. Here's what makes this industry fascinating. Unlike many technology businesses that rely on consumer popularity, this business is built almost entirely on trust. Imagine a bank trying to send millions of OTPs every day. Even a tiny delay could prevent customers from accessing accounts. Imagine an airline sending boarding information after the flight has already departed. Imagine a hospital failing to deliver appointment reminders. The technology itself isn't valuable because it sends messages. It's valuable because those messages must arrive accurately, securely, and almost instantly every single time. That is why enterprise communication has gradually evolved from being a convenience into critical digital infrastructure. And once businesses integrate these communication platforms into their systems, switching providers isn't always straightforward. Reliability, security, compliance, and scalability become just as important as cost. This creates an interesting economic characteristic. The more digital India becomes, the more valuable the underlying communication infrastructure becomes. But industries like these don't remain easy forever. Success attracts competition. Technology changes. regulations evolve. Cybersecurity threats become more sophisticated. Governments demand better protection against spam, scams, and identity fraud. Consumers expect faster communication while also demanding greater privacy. Companies operating in this space must constantly invest, not only in technology, but also in compliance, security, and innovation. In other words, this isn't simply a messaging business. It's a business that sits at the intersection of technology, regulation, telecom networks, enterprise software, and digital trust. And that's exactly what makes it so intriguing from an investor's perspective. Now think like an institutional investor for a moment. When does a business become truly interesting? Not necessarily when its stock price is rising, not when social media begins discussing it, but when powerful structural trends quietly begin working in its favor. India is digitizing. Enterprises are communicating more than ever before. Security requirements are increasing. Fraud prevention has become a national priority. Digital transactions continue expanding year after year. If all these trends continue for the next decade, then the obvious question isn't whether communication platforms will remain important. The real question becomes, which companies are building the infrastructure that enables this digital economy? And more importantly, has the market fully understood their long-term potential? Or is it only beginning to notice them? That question brings us back to Tanla platforms. In the next chapter, we'll move beyond the industry and uncover the story of the company itself. How a relatively unknown technology firm evolved into one of India's most important enterprise communication platforms, what differentiates it from competitors, and why understanding its business model is far more important than simply looking at its share price. Chapter 2. The company that built the invisible bridge. Documentary voiceover by Story Behind Stocks. Every great business begins by solving a problem that most people don't even realize exists. Railways solved transportation. Electricity solved power. The internet solved information. But as businesses moved online, a completely different challenge emerged. How do millions of companies communicate securely with billions of customers in real time? That question gave birth to an entirely new industry, Communications Platform as a Service, or CPaaS. Think of CPaaS as the digital equivalent of a national highway system. Imagine you're building a new city. You don't construct your own roads, traffic lights, toll booths, and bridges from scratch. Instead, you use an existing network that is already reliable, scalable, and maintained. Businesses face the same decision in the digital world. A bank could spend years building its own messaging infrastructure. An airline could create its own communication network. An e-commerce company could attempt to connect directly with every telecom operator in the country. But that would be expensive, time-consuming, and incredibly complex. Instead, they use platforms like Tanla. Imagine a customer trying to log into a banking app. The customer enters a password. Within seconds, the bank requests an OTP. That request doesn't magically appear on your phone. Behind the scenes, the message travels through multiple technology layers. Security systems verify the request, telecom operators route it across networks, delivery platforms ensure it reaches the correct device, and monitoring systems confirm successful delivery. All of this happens in just a few seconds. To the customer, it's a simple notification. To the business, it's a mission-critical process involving speed, reliability, security, and compliance. Tanla operates in this invisible layer of the digital economy. Its customers aren't individual consumers. Its customers are banks, e-commerce companies, fintech firms, healthcare providers, airlines, telecom operators, governments, and enterprises that need to communicate with millions of users every day. Here's where the story becomes more interesting. For many years, enterprise messaging was treated almost like a commodity. Companies believed that sending one SMS was no different from sending another. If prices were lower, customers switched providers. But digital communication gradually became much more sophisticated. Fraudsters learned to imitate banks. Scammers began sending fake payment links. Consumers started receiving thousands of spam messages. Trust began to erode. Suddenly, the industry's biggest challenge was no longer speed. It was trust. This shift changed the rules of the game. Businesses no longer wanted the cheapest messaging platform. They wanted the safest, the most reliable, the one capable of proving that every message was genuine. In investing, this is an important lesson. Industries often become far more profitable when customers stop buying based solely on price and begin buying based on reliability, security, and performance. That is exactly what happened in enterprise communications. The industry evolved from simply delivering messages to protecting digital identities. And Tanla positioned itself at the center of that transition. One of the company's most significant strategic moves was investing in technologies designed to combat spam and fraudulent communications. Rather than viewing regulation as an obstacle, Tanla recognized that stricter rules could actually strengthen businesses capable of meeting higher compliance standards. This is a pattern seen repeatedly across industries. When regulations become more demanding, weaker players often struggle because compliance increases costs. Larger, technologically advanced companies, however, can transform those requirements into competitive advantages. In other words, regulation can become a moat. Instead of asking, "How do we survive these new rules?" successful businesses ask, "How do we become indispensable because of them?" Another feature that makes Tanla's business attractive is its scalability. Imagine owning a bridge. Whether 100 cars cross it or 10,000, the bridge doesn't need to be rebuilt each time traffic increases. Technology platforms often behave in a similar way. Once the software, infrastructure, and security systems are in place, serving additional customers usually requires far less incremental investment than building the platform in the first place. This is why investors pay close attention to software and platform businesses. If demand continues growing while costs increase more slowly, profits can expand faster than revenue. Of course, this only happens if management executes well and competition doesn't erode pricing power. That brings us to an important question. If Tanla operates in such an attractive industry, why hasn't its stock always reflected that promise? Markets rarely value a company based solely on what it has achieved. They value it based on what they believe it can achieve next. There have been periods when investors questioned whether the company's rapid growth could continue. Competition intensified. Margins moderated from earlier highs. Institutional investors became more cautious. The market's enthusiasm faded, and the share price reflected those changing expectations. This is another timeless investing lesson. A great business does not always produce a great stock if expectations become unrealistic. Likewise, a temporarily unpopular stock can become interesting again if the underlying business quietly improves while market expectations remain low. That difference between business performance and market perception is where many long-term investment opportunities emerge. Today, Tanla appears to be at another important stage of its journey. Its business remains asset-light. Its balance sheet remains strong. Its platform continues to process enormous volumes of enterprise communication. The digital economy it serves continues to expand. At the same time, investors are watching closely to see whether the company can accelerate growth, improve profitability, and strengthen its competitive position in an increasingly sophisticated communications ecosystem. The next few years may determine whether Tanla remains simply a successful messaging company or evolves into a much broader digital infrastructure platform. And that depends largely on one factor: management, and more than quarterly earnings themselves. Because in technology businesses, products may create opportunities, but it is management that decides whether those opportunities become lasting shareholder value. In the next chapter, we'll step inside Tanla's leadership team, examining how management thinks about capital allocation, innovation, execution, governance, and long-term strategy, and why these decisions often matter more than quarterly earnings themselves. Chapter 3. The people behind the platform. Can management build the next decade? Documentary voiceover by Story Behind Stocks. If you've ever watched a cricket match, you've probably seen a team with incredible players still lose because of poor captaincy. On the other hand, an average team with exceptional leadership can consistently outperform expectations. Businesses work in much the same way. Technology can be copied. Products can be improved. Competitors can reduce prices. But one thing is incredibly difficult to replicate: the quality of management. When institutional investors evaluate a company like Tanla Platforms, they don't begin by asking, how much profit did it make this quarter? Instead, they ask a more important question. If we own this company for the next 10 years, do we trust the people making the decisions? Because in the long run, management doesn't just run a company. Management shapes its destiny. The difference between running a business and building one. Imagine two restaurant owners. Both earn the same profit. The first owner withdraws all the earnings every year. The second owner upgrades the kitchen, improves technology, trains employees, and opens new locations. 5 years later, which restaurant is likely to be worth more? Probably the second one. That's because wealth isn't created simply by earning profits. It's created by allocating those profits wisely. This is known as capital allocation, and it's one of the most important yet least understood concepts in investing. Capital allocation simply means, what does management do with every rupee the business earns? Do they distribute it? Do they invest it? Do they acquire other companies? Do they reduce debt? Or do they waste it? Great businesses are often built not by extraordinary products alone, but by extraordinary capital allocation decisions made consistently over many years. Reading Tanla's decisions instead of its annual report. When evaluating Tanla, it's helpful to look beyond management presentations and focus on what the financial statements reveal about their actions. Over the years, the company has maintained a very conservative balance sheet with debt remaining negligible relative to its equity base. At the same time, it has generated substantial operating cash flow and free cash flow, indicating that reported profits are translating into real cash rather than remaining only accounting numbers. Another notable feature is the gradual increase in reserves, reflecting that a meaningful portion of earnings has been retained within the business rather than entirely distributed. The company has also continued paying dividends, balancing shareholder returns with reinvestment. These choices suggest a management team that has generally preferred financial discipline over aggressive leverage. That doesn't automatically make every decision correct, but it does reveal a consistent philosophy. A different kind of technology company. Technology companies are often expected to chase growth at any cost. Many borrow heavily. Many issue large amounts of new shares. Many prioritize expansion even if profitability suffers. Tanla's journey has looked somewhat different. The company has focused on strengthening its core communication platform while maintaining healthy returns on capital and a relatively clean balance sheet. This reflects an important principle. Growing quickly is impressive. Growing profitably is much harder. And growing profitably without relying on debt is harder still. Leadership is also about adapting. No industry remains static. Enterprise communication today is very different from what it was a decade ago. Businesses no longer want only message delivery. They expect authentication, fraud prevention, regulatory compliance, analytics, and secure digital engagement. In other words, the job of management is no longer simply to sell a product. It is to anticipate how customer needs will evolve before competitors do. Companies that fail to adapt gradually become irrelevant. Companies that anticipate change often become industry leaders. For Tanla, this means continuing to evolve from being viewed as a messaging provider toward becoming a broader digital communications and trust platform. The challenge of expectations. Successful management teams also face an unusual problem. Once a company delivers exceptional growth, investors begin expecting that pace to continue indefinitely. Reality is rarely that simple. Industries mature, competition increases, margins fluctuate, growth naturally slows from extraordinary levels. When this happens, the market often becomes impatient, even if the underlying business remains healthy. This appears to be one of the phases Tanla has experienced. The company's financial quality has remained strong in several respects, but investor expectations have adjusted as growth moderated. This creates an interesting situation. Management no longer needs to prove that it can build a profitable business. It needs to demonstrate that it can create the next phase of growth. The signals institutions watch. Institutional investors rarely react to headlines alone. Instead, they look for a pattern. Quarter after quarter, they ask, is revenue consistently expanding? Are customers becoming stickier? Is cash generation improving? Are returns on capital remaining healthy? Is management delivering what it previously indicated? Trust isn't built through one excellent quarter. It's built through years of meeting or exceeding expectations. When management consistently executes well, institutions gradually gain confidence. And when confidence grows, valuation often follows. Where Tanla stands today, based on the financial trends discussed so far, Tanla appears to be at an important point in its corporate journey. It has already proven that it can build a scalable platform. It has demonstrated financial discipline through low leverage and strong cash generation. It has maintained respectable returns on capital. The next challenge is different. Can management convert these strengths into a faster-growing business while preserving profitability? Can it deepen relationships with enterprise customers? Can it continue innovating as digital communication becomes more secure, more intelligent, and increasingly shaped by technologies such as automation and artificial intelligence? Those are the questions that will define the company's next decade. A thought worth remembering. Many investors believe that buying a stock means buying a ticker symbol. Long-term investors understand something different. You are buying a team of decision makers. Every acquisition they approve, every technology they invest in, every customer relationship they build, every rupee they allocate, eventually finds its way into shareholder returns. And that's why, before looking at the next quarterly result, experienced investors often spend far more time understanding the people making those decisions. Because businesses can survive difficult years, products can evolve, markets can recover. But over long periods, management quality compounds just as powerfully as capital itself. So far, we've explored why the industry exists, how Tanla fits into it, and whether management has built a disciplined foundation. But none of that answers the question investors ultimately care about. Has all this translated into a business that is becoming stronger year after year? To answer that, we'll move beyond headlines and into the numbers. Not to recite financial statements, but to uncover the story they tell about Tanla's evolution, its strengths, its weaknesses, and whether the business is quietly entering a new phase of growth. Chapter 5. When numbers tell a story, reading Tanla like an institutional investor. Documentary voiceover by Story Behind Stocks. Imagine you're standing outside two restaurants. One has a long queue stretching onto the street. The other has empty tables, polished interiors, and attractive discounts, but very few customers. Which restaurant would you choose? Most people would instinctively walk toward the one with the queue. Not because they know the food is better, but because the crowd is telling them something. Financial statements work in a similar way. Revenue, profits, cash flow, margins, and return ratios aren't just numbers. They're like the crowd outside the restaurant. They reveal whether a business is quietly becoming stronger or gradually losing its appeal. But here's where many investors make a mistake. They read financial statements as if they're reading a report card. Institutional investors read them as if they're reading a detective novel. Every number is a clue. every trend tells a story. And when we examine Tanla platforms through that lens, an interesting picture begins to emerge. Revenue. Is the business still finding more customers? The first question institutions ask is remarkably simple. Is the business becoming more relevant? Revenue is often the first place to look. Over the last several years, Tanla sales have continued to move upward, though not in a straight line. After the explosive growth that accompanied India's rapid digital transformation, the company entered a period where expansion became steadier rather than spectacular. More recently, quarterly revenue has shown renewed momentum, suggesting that demand for its enterprise communication services remains healthy. This is an important distinction. A mature platform doesn't need to double every year to create value. What matters is whether it continues adding business while retaining existing customers. Think of a large airport. Once it has reached a certain size, growth naturally slows. But if passenger traffic keeps increasing year after year, the airport becomes more valuable because it is handling greater economic activity. Tanla appears to be in a similar phase. The days of explosive expansion may have moderated, but the platform is still processing increasing business volumes. Profitability. Growth is good, profits are better. Now imagine a shopkeeper whose sales double, but whose profits don't. At first glance, the business looks successful. But if costs are rising just as quickly, the owner isn't actually becoming richer. That's why investors look beyond revenue. They ask whether growth is translating into profits. Tanla has remained consistently profitable, and its latest quarterly results indicate that profits have begun improving again. However, compared with the extraordinary growth rates seen a few years ago, earnings have expanded at a more measured pace. This tells us something important. The business isn't broken. It's simply operating in a more competitive and mature environment. For investors, that's a subtle but crucial difference. A slowing growth rate doesn't automatically mean a weakening business. Sometimes it simply means the company has moved from adolescence into adulthood. Margins, the company's pricing power. Imagine two taxi drivers. Both earn the same amount in fares. One spends most of it on fuel and maintenance. The other keeps a much larger share as profit. Which business is healthier? The second one. Operating margin measures exactly that. It tells us how much of every rupee of revenue remains after paying the day-to-day costs of running the business. Tanla once operated with margins above 20%. Today, those margins are closer to the mid-teens. At first, that might sound disappointing. But context matters. As industries mature, competition often increases. Customers negotiate harder, technology evolves, and companies invest more heavily in innovation and compliance. The important question is not whether margins have fallen from their peak. It's whether they remain healthy enough to support future investment and shareholder returns. At present, Tanla still generates respectable operating margins, though investors will be watching closely to see whether management can gradually improve them again. Cash flow. Can the business turn profits into cash? Here's one of Warren Buffett's favorite ideas. Accounting profits are useful. Cash is essential. Imagine you own a business that reports huge profits but never actually receives the money from customers. Would you call that a successful business? Probably not. Cash flow answers this question. It measures whether profits eventually arrive in the bank account. One of Tanla's strongest financial characteristics has been its ability to generate operating cash flow consistently. Even more encouraging, its operating cash flow has closely matched, or even exceeded, its operating profits in several years. Why is that important? Because it suggests the profits are backed by real economic activity rather than accounting adjustments. Institutional investors often trust businesses far more when cash tells the same story as earnings. Debt, freedom creates opportunity. Now imagine two families. One has a large home loan consuming most of its monthly income. The other has very little debt. When an unexpected opportunity appears, which family can act more quickly? The one with financial flexibility. Companies are no different. Tanla's balance sheet remains exceptionally clean, with very low debt relative to its equity and extremely strong interest coverage. This gives management options. They can invest in technology, expand products, reward shareholders, or navigate difficult economic periods without the pressure of heavy loan repayments. A strong balance sheet doesn't guarantee success, but it often gives businesses more time and flexibility to adapt. Return on capital. Is management creating wealth? Imagine lending 100 rupee to two entrepreneurs. 5 years later, one has turned it into 120 rupees. The other has turned it into 250 rupees. Who would you trust with more capital? This is exactly what return on capital employed, ROCE, attempts to measure. Tanla continues to generate returns on capital that are comfortably above average. Although these returns have moderated from earlier peaks, they remain strong enough to suggest that management is still deploying capital efficiently. High-ROCE businesses often poses something valuable, either a competitive advantage or a management team that knows how to allocate resources wisely. Sometimes both. The missing piece. So, if revenue is growing, profits remain healthy, cash flow is strong, debt is almost non-existent, and returns on capital remain impressive. Why hasn't the stock always reflected that strength? Because markets don't reward yesterday's performance. They reward tomorrow's expectations. Investors are now asking a different question. Can Tanla return to a phase where earnings grow faster than they have over the past few years? Can margins stabilize or even improve? Can new products and technologies create another wave of expansion? The answers to those questions will determine whether the next decade looks very different from the last. A lesson bigger than Tanla. Every company eventually reaches a crossroads. The first stage is proving the business model works. The second is scaling it. The third, and often the hardest, is reinventing growth before the existing engine begins slowing down. Tanla appears to be standing at exactly that intersection. Its financial foundation remains strong. Its cash generation remains impressive. Its balance sheet offers flexibility. Its industry continues evolving. But the market is waiting for evidence that the next chapter of growth has already begun. And that's why experienced investors don't just study the numbers. They study how the numbers are changing. Because trends, not snapshots, are what ultimately shape long-term wealth. Transition to Chapter 6. So far, we've uncovered the industry's evolution, the company's business model, management philosophy, and the financial story hidden inside the numbers. But investing isn't only about understanding a business. It's also about understanding how the market gradually changes its opinion of that business. In the next chapter, we'll explore investor psychology, institutional behavior, and why stock prices often move long before the majority of investors notice what's changing beneath the surface. Chapter 7. The Market's Silent Vote. How Institutions Think Before Everyone Else. Documentary voiceover by Story Behind Stocks. Imagine you're standing outside a theater. The movie hasn't started yet. There are no reviews, no ratings, no social media reactions. Yet, you notice something interesting. A few people quietly begin taking the best seats. They don't make any noise. They don't tell others. They simply arrive early because they believe the movie is going to be worth watching. Half an hour later, the theater is full. To the crowd, it looks like everyone suddenly discovered a great movie. But in reality, the smartest viewers arrived much earlier. The stock market works in remarkably similar ways. By the time a company dominates television debates, becomes the favorite topic on social media, and starts appearing in every investment discussion, much of the easy money has often already been made. Institutions rarely chase excitement. They try to recognize changing business quality before changing market sentiment. And that's one of the most misunderstood aspects of investing. The market doesn't reward good companies. This may sound surprising, The market doesn't reward companies simply because they're good. It rewards companies whose future turns out to be better than what investors currently expect. Think about the students. One always scores 95%. The other usually scores 60%, but suddenly starts scoring 85%. Who surprises everyone? The second student. The same logic applies to businesses. A company with average expectations can deliver extraordinary stock returns if its business improves faster than the market anticipated. Meanwhile, an excellent company can disappoint investors if expectations become unrealistically high. This is why institutional investors spend less time asking, "Is this a good company?" and more time asking, "Has the market misunderstood where this business is heading?" Why institutions rarely buy at the peak. Retail investors often imagine institutions buying when prices are soaring. Reality is usually different. Large investors manage enormous amounts of capital. They cannot simply buy millions of shares in one afternoon without pushing prices sharply higher. Instead, they build positions gradually. Weeks, sometimes months, occasionally even years. Imagine filling a large water tank using a small pipe. You don't notice the water rising every second. But after several hours, the tank is almost full. Institutional accumulation often looks exactly like that. Not dramatic, not emotional, just patient. This is why stock prices sometimes move sideways for long periods, even while the underlying business quietly becomes stronger. The market appears inactive, but beneath the surface, ownership may slowly be changing hands. What changes institutional opinion? Institutions rarely change their minds because of one impressive quarter. They look for a sequence. A company reports better sales. Then profits improve. Cash generation strengthens. Management delivers on previous commitments. Customers stay longer. New business continues arriving. Debt remains low. Return on capital stays healthy. Eventually, confidence begins to compound. Notice something important. Confidence doesn't appear overnight. It is earned, exactly like trust between two people. Tanla's journey through market psychology. Tanla provides an interesting example of how market perception evolves. There was a period when investors viewed the company as one of the fastest growing technology businesses in India. Optimism expanded. Valuation followed. Then came a different phase. Growth moderated. Margins softened. Institutional ownership declined. The narrative changed. Suddenly, many investors began focusing more on what the company might lose than on what it could still become. But markets have a habit of swinging between two extremes: excessive optimism, excessive pessimism. Rarely do they spend much time in the middle. For long-term investors, the opportunity often lies somewhere between those two emotional extremes. The behavioral traps. This is where psychology quietly becomes more important than finance. One of the biggest mistakes investors make is anchoring. Suppose someone bought Tanla near its previous highs. Every future decision becomes influenced by that old price. Instead of asking, "What is the business worth today?" they keep asking, "Will it return to the price where I bought it?" The market doesn't care where anyone purchased a stock. It only reflects the collective expectations of millions of participants about the future. Another common mistake is confirmation bias. When investors become bullish, they search only for positive news. When they become bearish, they notice only negative headlines. Institutional investors try to do the opposite. They actively search for evidence that challenges their own opinion. Because protecting capital often matters more than proving yourself right. What is the market watching today? At this stage, the questions surrounding Tanla are no longer about survival. The company has already demonstrated that it can build a profitable platform, generate healthy cash flows, and maintain a disciplined balance sheet. Instead, the market is watching for something more subtle. Can revenue continue accelerating? Can operating margins stabilize or improve? Can new products contribute meaningfully? Can enterprise customers deepen their engagement? Can management execute consistently enough to rebuild institutional confidence? These questions matter because stock prices don't move on today's numbers alone. They move on changing expectations about tomorrow. From numbers to narrative. One of the greatest lessons in investing is that markets don't trade spreadsheets. They trade stories. Not fictional stories. Business stories. A decade ago, the dominant story around Tanla was rapid expansion. Later, the story shifted towards slowing growth and increasing competition. Now, the company stands at another interesting point. If management demonstrates that the next phase of growth is taking shape, the market's narrative could gradually begin changing once again. And when narratives change, valuations often change with them. Not because accounting suddenly improves overnight, but because investor confidence evolves. The quiet signals institutions notice. Experienced investors rarely wait for certainty. By the time certainty arrives, the opportunity is often smaller. Instead, they look for subtle changes. Not headlines. Not excitement. Patterns. Improving execution. Consistent financial discipline. Better customer traction. Steady cash generation. Evidence that the business is quietly becoming stronger than public perception suggests. Those are the kinds of developments that gradually reshape institutional opinion. Not in a day, but over many quarters. A lesson beyond Tanla. Whether we're studying Tanla, a manufacturing company, a bank, or a consumer brand, one principle remains unchanged. The market is a voting machine in the short term, but a weighing machine in the long term. In the short run, emotions dominate. Fear, greed, excitement, disappointment. But over longer periods, the market begins weighing something far more important. Business quality, management execution, cash generation, competitive advantage, capital allocation. And when those factors improve consistently, market perception often follows. Sometimes quietly, sometimes suddenly. We've now explored the industry, the business model, management quality, financial evolution, and the psychology that shapes market perception. But one final question remains. Even if a business is improving, how should we think about what it's worth? Because a wonderful company purchased at an unreasonable valuation can still become a poor investment, while misunderstood business, bought with the right expectations, can create extraordinary long-term wealth. In the next chapter, we'll explore valuation, not as a mathematical exercise, but as the art of understanding what a business is truly worth, why markets sometimes overpay or underpay, and how institutional investors decide when quality justifies the price. Chapter 9. Beyond the balance sheet. What must happen next for Tanla? Documentary voiceover by Story Behind Stocks. Every successful business reaches a moment where the past is no longer enough. Think about Nokia. There was a time when almost every second mobile phone carried its logo. The company wasn't weak. It wasn't bankrupt. It wasn't badly managed overnight. The world simply changed faster than Nokia did. Now think about Amazon. Originally, it sold books. Today, cloud computing contributes a significant share of its profits. The company kept reinventing itself before its existing business stopped growing. These two stories teach one timeless investing lesson. The companies that create the greatest wealth are rarely the ones that protect yesterday's success. They're the ones that build tomorrow's business before today's business begins slowing down. And that brings us to the most important question about Tanla platforms. Not, how much profit did it make this quarter? But, what must happen over the next 5 years for Tanla to become a much larger company? Because that is exactly how institutional investors think. The difference between growth and re-rating. Many investors assume that if a company's revenue increases, its stock price will automatically rise. History tells a different story. Imagine two businesses. The first grows revenue by 15% every year, exactly as everyone expected. The second also grows by 15%. But the market expected only 5%. Which stock is likely to perform better? Usually the second one. Not because it grew faster, but because it exceeded expectations. This is called re-rating. A company's valuation expands when investors begin believing its future is brighter than they previously assumed. For Tanla, this distinction is critical. The business has already demonstrated financial discipline. The next phase is about changing perception. The 5 engines that could shape Tanla's next decade. Rather than thinking about one single catalyst, imagine Tanla as an aircraft. An aircraft doesn't fly because of one engine. It flies because several systems work together. Similarly, Tanla's future depends on multiple growth engines operating simultaneously. Engine 1, India's digital economy. Every year, millions of Indians adopt new digital services. Banks digitize more products. Insurance companies automate customer communication. Hospitals use digital appointment systems. Government services become increasingly paperless. Every additional digital interaction creates another opportunity for secure enterprise communication. Tanla doesn't need to create this trend. It simply needs to remain one of the companies enabling it. Engine 2, security, will become more valuable than messaging. Years ago, sending a message was enough. Today, businesses care about something else. Can customers trust that this message is genuine? Fraud prevention, identity verification, and secure communication are becoming essential rather than optional. This changes the economics of the industry. When customers buy trust instead of merely buying message delivery, pricing power often improves. Companies capable of delivering reliability become more valuable. Engine 3, artificial intelligence. Artificial intelligence is transforming almost every technology business. Most people think AI will replace communication. The reality may be exactly the opposite. AI could dramatically increase communication volumes. Imagine intelligent banking assistants, healthcare reminders personalized for each patient, retail notifications tailored to customer behavior, automated customer support, fraud detection systems communicating instantly with users. Every AI-powered interaction still requires secure communication. If Tanla successfully integrates AI into its platform, it may participate in an even larger ecosystem than it does today. But this opportunity is also a challenge. The company must innovate quickly enough to remain relevant as enterprise communication evolves. Engine 4, international expansion. Today, Tanla is strongly associated with the Indian market. India itself offers a long runway for digital growth. However, every management team eventually faces a strategic question. Should we depend our leadership in one market or replicate our success globally? International expansion offers enormous potential, but it also introduces complexity. Different regulations, different telecom operators, different customer behavior, different competitors. Scaling internationally requires not just technology, but execution. Investors will watch whether Tanla chooses this path and, if so, how effectively it manages the transition. Engine 5. Winning the confidence of institutions again. Perhaps the most important catalyst isn't technological at all. It's psychological. Markets don't suddenly wake up one morning and decide a company deserves a higher valuation. Confidence builds gradually. One good quarter, then another. Margins stabilize. Cash flow remains strong. Management delivers on guidance. Large investors begin returning. Retail investors notice only after the trend becomes obvious. Institutional conviction is rarely built through headlines. It is built through consistency. What could go wrong? Every great investment thesis deserves an equally honest discussion of risk. One of the biggest dangers is competition. Technology rarely stands still. New platforms emerge. Pricing pressure increases. Customers demand more for less. Another challenge is regulation. While stronger compliance requirements can benefit established players, they also require continuous investment. Then there is execution risk. A good strategy is only valuable if management can implement it consistently. Finally, expectations themselves can become a risk. If investors begin assuming perfection, even strong results may disappoint. This is why successful investing is never about ignoring risk. It is about understanding whether the potential reward justifies accepting that risk. The institutional checklist. If a professional fund manager were reviewing Tanla today, the questions might sound like this. Is the business still relevant in a rapidly digitizing economy? Can management continue innovating ahead of competitors? Are cash flows supporting reported earnings? Does the company maintain financial discipline? Is customer demand becoming stronger or weaker? Can earnings grow faster than market expectations? Notice something interesting. Very few of these questions involve today's share price. Because institutional investors know something many beginners eventually learn. Share prices change every second. Business quality changes much more slowly. And it is usually business quality that determines shareholder wealth over long periods. A reflection worth remembering. Imagine planting a mango tree. For several years, nothing remarkable seems to happen. The tree grows quietly. Roots spread beneath the soil. There are no fruits, no visible rewards. An impatient observer might conclude that nothing is happening. Then, one season, the tree begins producing fruit. The harvest seems sudden, but the real work had been happening underground for years. Businesses often follow the same pattern. Markets usually notice the fruit. Institutions spend their time studying the roots. Perhaps that's the most important lesson from Tanla's journey. The company is not simply competing to send more messages. It is competing to become a trusted layer of India's digital infrastructure. Whether it succeeds will depend not on one exceptional quarter, but on years of disciplined execution, innovation, and capital allocation. And if those roots continue growing stronger, the market may eventually see a very different tree than the one it sees today. We've explored the invisible industry, the business model, the leadership, the financial evolution, market psychology, valuation, and the future possibilities. But before this documentary ends, one final question remains. What is the single biggest investing lesson that Tanla platforms teaches us? Not just about one company, but about how long-term wealth is truly created in the stock market. In the final chapter, we'll step back from Tanla itself and reflect on the timeless principles that separate successful business owners from short-term stock traders. Final chapter. The real story behind Tanla. Thinking like a business owner, not a stock trader. Documentary voiceover by Story Behind Stocks. At the end of every great business story lies a much bigger lesson, not about the company, but about the investor. Over the last hour, we've traveled through India's digital transformation. We've explored an invisible industry that quietly powers billions of conversations. We've understood how Tanla platforms became an important part of that digital ecosystem. We've examined its management, its financial evolution, the psychology of markets, valuation, institutional behavior, and the possibilities that may shape its future. But before we close this documentary, let's step away from Tanla for a moment. Because this story was never just about one company. It was about learning how wealth is actually created. The market rewards patience, not predictions. When most people enter the stock market, they ask one question. Which stock will double next? Institutional investors ask a completely different question. Which business is becoming stronger every year? The difference may sound subtle. In reality, it changes everything. Because nobody consistently predicts short-term prices. But great investors spend decades identifying businesses that steadily improve. Markets fluctuate. Businesses evolve. And over long periods, it is the evolution of the business, not the daily movement of the stock, that determines wealth. Tanla is more than a messaging company. At first glance, Tanla appears to be a company that delivers enterprise messages. But by now, we know that's an incomplete description. It helps banks authenticate customers. It helps payment companies build trust. It enables e-commerce platforms to communicate with millions of users. It supports healthcare providers, airlines, telecom operators, governments, and enterprises in an economy where secure digital communication has become essential. In many ways, Tanla resembles the plumbing inside a modern city. People rarely think about pipes when they turn on a tap. But remove the plumbing, and the city stops functioning. The most valuable businesses often operate in exactly this way. Invisible, essential, and quietly becoming more important every year. The difference between noise and signal. Every day, the financial world produces an endless stream of information. Television debates, breaking news, social media opinions, broker upgrades, downgrades, rumors, price targets. For a new investor, all of this feels important. For an experienced investor, much of it is simply noise. The real signals are much quieter. Has the company strengthened its competitive position? Are customers becoming more dependent on its services? Is management allocating capital wisely? Is cash generation improving? Is innovation keeping pace with industry change? These questions rarely trend on social media. Yet they are often the questions that determine where a business stands 5 or 10 years later. The quiet power of compounding. Imagine planting a banyan tree. For the first few years, growth appears painfully slow. You might even wonder whether anything meaningful is happening. But beneath the surface, an extraordinary network of roots is spreading. One day, those invisible foundations begin supporting a tree that lives for generations. Businesses compound in exactly the same way. Innovation compounds. Customer trust compounds. Management experience compounds. Capital allocation compounds. Cash flows compound. Even reputation compounds. And when these forces reinforce each other year after year, extraordinary businesses emerge. Not because of one brilliant decision, but because of hundreds of disciplined decisions made consistently over time. Tanla's future will ultimately depend on this principle. Not whether one quarter surprises analysts, but whether the business continues strengthening the roots beneath the surface. Every investment is a bet on human decisions. It's tempting to think that investing is about buying numbers on a screen, a stock ticker, a price chart, a valuation multiple. But those numbers are only the scoreboard. Behind every number are people making decisions. Engineers building products. Sales teams winning customers. Managers allocating capital. Leaders deciding whether companies should invest next. Every investment is, in reality, an investment in human judgment. And that's why management quality matters so deeply. Technology changes. Industries evolve. Competition intensifies. But disciplined decision-making has an extraordinary ability to create long-term value. What Tanla must prove next? Tanla has already demonstrated several qualities that investors appreciate. A debt-light balance sheet. Healthy cash generation. Strong returns on capital. A meaningful role in India's digital communication infrastructure. But every business eventually reaches a new test. The next chapter for Tanla is not about proving that it can survive. It's about proving that it can reinvent growth. Can it expand beyond traditional messaging? Can it deepen enterprise relationships? Can it leverage artificial intelligence responsibly? Can it strengthen its competitive moat as digital trust becomes increasingly valuable? Can management continue delivering disciplined execution while the industry evolves around it? These are the questions that will shape the company's next decade. And perhaps more importantly, they're the questions that will shape investor confidence. The 3 lessons every investor should remember. If this entire documentary could be reduced to just 3 ideas, they would be these. Lesson 1. Great businesses usually become obvious only after they have already spent years improving. Markets rarely recognize quality immediately. Most long-term winners look ordinary before they become extraordinary. Lesson 2. A stock price is an opinion. A business is a reality. Prices move because emotions change. Business value changes because execution changes. Over long periods, reality has a remarkable way of catching up with opinion. Lesson 3. Wealth belongs to those who understand businesses, not those who chase headlines. Markets will always be noisy. Fear and greed will never disappear. But investors who consistently focus on management quality, competitive advantage, capital allocation, financial strength, and long-term industry trends often give themselves a meaningful edge. One final reflection. When historians look back at India's digital transformation, they may remember the banks that embraced technology, the fintech companies that changed payments, the e-commerce platforms that transformed retail, the government initiatives that accelerated digital adoption. But hidden behind many of those stories are companies that quietly built the infrastructure enabling them to succeed. Tanla Platforms is one such company. Whether it eventually becomes one of India's enduring technology leaders is a question that only time can answer. But perhaps that's not the most important question. The more important question is this: have we learned to see businesses the way long-term owners do? Because once you begin looking beyond stock prices, beyond quarterly headlines, beyond market excitement, you stop asking, which stock should I buy? And you begin asking, which business is quietly becoming stronger while the world is looking somewhere else? That shift in thinking is where long-term investing truly begins. Closing. This has been the story of Tanla Platforms. Not just a company that delivers billions of messages, but a business operating at the heart of India's digital economy, navigating technological change, regulatory evolution, and shifting investor expectations. Whether Tanla ultimately delivers exceptional shareholder returns will depend on execution over the coming years, not on a single quarter or a single market cycle. As investors, we don't control those outcomes. What we can control is how we think. And perhaps the greatest investment we can ever make is not in a stock, but in becoming a better student of businesses. If you enjoyed this documentary and want to discover the hidden stories behind India's most fascinating listed companies, subscribe to Story Behind Stocks. Because behind every stock chart lies a business, and behind every great business lies a story worth understanding.